Well, hi everyone, and welcome to today's webinar, which is the International Investing Made Easy. I'm Tom Wilson. I'm one of the investor education specialists at InvestSMART, and I'm joined by Head of Portfolio Services, Mitchell Sneddon. Welcome.
Yeah, thanks, Tom.
And I'll just quickly get through the slides. And this is being live streamed on YouTube as well. And you can ask questions on the streaming platform. They'll appear. We can even post some of them on the screen as well. Just always remember that any advice we give is general product advice only, not any type of personal financial advice. But we'll dive into the first webinar. And basically, we've put this webinar together to, I guess, help one of the problems that we've noticed with at least 90% of the Australian clients that we have on our InvestSMART portfolio tracker tool, which shows that they are heavily underweight international shares. And one of the things we try and go through at InvestSMART is obviously diversification is key, and international equities is a big component of it.
Yeah, I think what we've seen a lot of lately is investors out there who are lacking in international exposure and say significantly overweight in the Australian market. If you look back at your returns over the last 12 months, specifically, you would find quite a glaring hole in your portfolio returns compared to those who have had adequate exposure to international equities. If we look at our international equities portfolio over the last 12 months, and 12 months is a very short time frame, but that portfolio has returned approximately 20% in a 12-month time frame. So the whole purpose of this webinar is not to say, hey, portfolio has done 20%, let's jump on it. It's to say a well-rounded portfolio deserves some international exposure, and we're going to walk through the benefits of it, how you can get it, and what you can do to set your portfolio up for future success.
Excellent. Yeah, and I guess running through some of the reasons why you would actually have international equities in a portfolio, and I've listed some here. I'll just make it a bit bigger, get rid of my noggin there. But basically, with diversification, I've got 5 points here, and they might seem fairly self-evident, but when you diversify and actually look to overseas, you're not just putting your eggs in one basket, so to speak, which is a term everyone loves talking about in finance. You're not basically limiting yourself to the Australian market. You're allowing yourself to get some of the growth potential from overseas. And we've put there like US and China with their tech markets as well. There's the currency diversification. So you're not just reliant upon the Aussie dollar to the US. There's exposure to overseas markets too, like the European market, the Asian markets as well.
And I guess there's diversification away as well from the cyclicality of the Australian market. If you look at the breakdown, and we're going to go into this a bit further as well, the breakdown of the different sectors that make up, say, the ASX 200 for those people who are get their exposure through that. You see resources and materials companies make up quite a large chunk of that. And so they are by nature quite cyclical. So you can diversify away from that particular risk as well by adding international to your mix.
Yeah, and we were even talking about the maturity as well of the Australian market, weren't we, just the other day? I thought it was a bit immature, but I got my terminology mixed up. So it does happen.
Yeah, so the maturity of the Australian market, really, when you look at once again, the breakdown of the ASX 200, it's dominated by the banks, by a telco, by a couple of supermarkets. And these are businesses that have been around for decades. They pay very large dividends. There's a reason for that, being one, our taxation system really encourages those dividends to be paid. But also, that if they were to retain that cash and reinvest that within the business, they wouldn't be probably getting the levels of profitability and return on equity that they are. So it's best for them to pay those out as dividends, because there is a natural ceiling here in Australia. Our population is not enormous compared to other parts of the world. And so there is a natural ceiling. As I've said previously, there's only so many home loans that Commonwealth Bank can sell.
Yeah. Even though they do try their hardest with that.
Maybe you need to try a Wells Fargo approach. Wells Fargo in the US. There was a bank in the US where they kept on signing clients up to different products. I think they had an internal saying eight is great or something like that.
Yeah, so let's learn from that. And we're getting your questions as they're coming through. And what we might try and do is just keep some of the questions as they go through, because we're going to bring in Nick Cummings now. And Nick is one of the analysts that works at Intelligent Investor. And he's got a lot of experience with international markets, overseas companies. So hi, Nick. Thank you so much for joining us. How's it going there in sunny Newcastle?
It's good. Thanks for having me, Tom and Mitch. Looking forward to it.
Yeah. So we thought, Nick, we'd bring you in just to go over the some of the concerns a lot of people have, like the common reasons why people don't go international, and then also for you to take us through, say, some of the quality metrics of these international businesses that that people can get exposure to.
Yeah, absolutely. I think one of the biggest pushbacks is just what we see on this slide here. It's currency risk. People don't want to have currency risk and portfolio or stock and index risk. It just complicates things. But what we find over time is currency really only influences short-term returns. In the long term, it's actually stock selection and index selection that matters. So if you look at the 4 periods here, only one of those periods has it really moved. This is the Australian dollar versus the US dollar exchange rate. Only one of those periods has it been materially different than 70 cents. And then over the long term, it really just averages 70 cents. So if you're in there for 5 or 10 years, or you're investing overseas for 5 or 10 years, I don't think currency is a major concern to worry about. The other thing to recognise too is if you're investing domestically in Australian stocks, they have currency risk. I know before, Mitch, you mentioned some of the big miners. So BHP, for example, they report in US dollars. CSL, one of the largest businesses on the ASX, they report in US dollars, and they recently downgraded because of currency fluctuations. So these risks are already present if you're investing in Australia, and they're no different than if you invest overseas.
Great, excellent. And so, Nick, one objection that I often hear from investors is, well, you say that the Australian at the ASX 200 is overweight banks and resources. Am I not just swapping the concentration risk here in Australia to those specific sectors for tech if I jump across, say, to the US? Am I not just swapping one risk out for another and being overweight tech? So I think you've got a slide here that takes us through the ASX 200 versus the MSCI All World Index, and the sectors we've got there.
Yeah, absolutely. And the short answer is I don't think you are swapping one diversification risk or lack of diversification for another. If you just look at the graph or the chart there, the MSCI is very diversified. Even the information technology sector is only just over 20%. And the next largest is financials at around 15%. But if you drill down into where the ASX is overweight, so financials and materials, the big 4 banks pretty much sell home loans to Australians. That's the only products, and they compete on rates and deposits and a few other things, but it's very much a commodity business. And the material sector is just that. It's pretty much iron ore miners and absolutely a commodity business. So there's not much diversification with the business models in those sectors. Whereas if you look at the information technology sector, particularly in the US, but across the globe, it's actually very diversified in the business models that sit in the within that sector. So if you look at a Microsoft, it has a different customer compared to Apple, that has a completely different business model compared to Tesla or Nvidia, that help make up that sector. So I think the actual the sector makeup of the information technology sector is actually pretty well diversified, whereas that's not the case in financials or materials on the ASX 200.
Excellent. Do you want to ask that question there that's
Yeah.
just come through? I think
Yeah.
it's a good one.
It's a question that came through from Peter, and it's a very good one as well. It's why can't you have your overseas investments via great Australian listed companies such as CSL or ResMed? And are there any LICs that are listed on the ASX which invest overseas, such as Intelligent Investors' own Select Value Fund, which we launched that about, was it
6 months ago?
6 months ago? Yeah, which you're integral with. Hey, Nick.
Yeah, absolutely. Second question first. There's plenty LICs listed on the ASX, which also invest overseas. Some of the big ones are Magellan. I think Platinum's got a number on there as well. And then
Magellan,
the first
Platinum.
question, and there's a few others. I think PM Capital as well. The first question on why can't you just invest in overseas companies here locally? You can do that, but we're still short a lot of good overseas companies. So we don't have really anything, for example, in semiconductors, which is a massive sector. We don't have anything in really massive in information technology. We don't have a car manufacturer. So there's a lot of areas where we're probably it's been a good place that we don't have a car manufacturer over the last couple of decades. But there's a lot of places where Australia is short companies that have been great winners over the last decade.
And he says as well, just going back on the LIC comment, you might see there's been a fair bit of media recently, or not a fair bit. There's been an article or two. You're seeing LICs out there that are really struggling and have been struggling for quite a long time to close their discount to their share price to NTA. You're seeing a lot of LICs potentially look to actually wrap up and convert into open-ended funds and things like that. So they potentially are a bit of a dinosaur of the ASX. They've certainly been usurped by ETFs. And the Intelligent Investor Fund that Peter mentioned there, the Intelligent Investor Select Value Fund, that's a listed active ETF. So it's not a LIC, so there's no discount or premium from the NTA to the share price. So that's just important to keep in mind. Now, Nick, let's jump over to look at the actual quality of the businesses. I know Nathan Bell in your team has often actually said when you do invest in international equities, you're actually opening yourself up to a higher quality business than what we've got in Australia here. Can you dive into that a bit for us?
Yeah, absolutely. And while the other two slides are pushbacks against investing overseas, this is the reason why you do it. And diversification doesn't come at the expense of performance or quality. And just to tackle quality, I mean, have a look at the table there. The average MSCI world business earns a 20% return on equity, almost double that of the ASX. That means they're getting more value for their dollar, every dollar they put into that business. And also they're growing quicker. So they're finding more reinvestment opportunities and more ways to grow their earnings compared to the ASX. The other thing that's usually brought up that can be a pushback is the dividend yield. And while at 2% to 4%, it's a large discrepancy. That actually probably doesn't, it's not a good reflection of actually the capital allocation framework, because a lot of the overseas businesses choose to do buybacks instead of dividends. So you are still getting capital return, but you're getting it just in a different form. But by far, like essentially the reason we started the Intelligent Investor Select Value Fund was we were just finding much higher quality businesses for more reasonable prices overseas, and that's still the case. And without going into stock specific examples, there's just so many, it's countless.
Great, Nick. We really appreciate you joining us here today and giving a few of those insights. We know you're a pretty busy fella, so we'll let you go, but we do appreciate your time.
Awesome. Thanks, guys. Thanks for having me.
Thanks, Nick. And the Intelligent Investor Select Value Fund trades on the ASX as an ETF, has the ticker code of IISV, so IISV.
Yeah, so jump on your ComSec account, your NabTrade, your CMC, whatever you use, and do check it out.
Yep. And then here's a quote from your friend and mine, Harry Markowitz.
Right, yeah. So what we're jumping into now is just talking about the how much international equities a portfolio should have, and the reason behind it. So Harry Markowitz here, the reason why we've popped him up, he's kind of, he's probably he's one of the figureheads behind the fundamentals of the InvestSMART approach. So Nick and his team at Intelligent Investor, they do select individual companies. The InvestSMART approach is to actually take a basket of those companies and use a passive ETF or indexing approach to investing. So why choose one or two when you can have a lot? And so that actually all stemmed from Harry Markowitz's investment approach, basically saying you can take an index approach to investing, have your capital spread across different asset classes, so Australian equities, international equities, property, infrastructure, etc., and you can still get adequate returns and lower your risk. Yep. So, thank you, Harry. So let's just jump over here and onto this page. So what we're breaking down here is we've put up basically the InvestSMART Diversified Portfolios. So we've got InvestSMART Conservative, Balanced, Growth, High Growth. Where you sit across these and how to determine where you sit across these, take a look at the timeframes that each one is invested for, or the is recommended. Conservative, I believe it's 2+ years. Balanced is 4+ years or 3+ years.
Yeah, it's 4.
Four.
I think. Yep.
Growth is 5+. High growth is 7+.
Yep.
And so what we've highlighted here, the green section, the green component, that's international equities. And even in a conservative portfolio where someone's retired, living off their income, etc., we do still allocate a portion of capital to international equities. The reason for that is you still need a bit of growth in that phase of life. People are living for longer, etc., and so you do still need that small amount, as it's quite a conservative amount in a conservative portfolio of 11% to international equities there. Now, inversely, if you jump up to the high growth side of things in our portfolios currently, it's almost 50% of a client's portfolio is international equities. And as we were talking at the start, over the last 12 months, maybe 12 to 18 months, that component of international equities has definitely carried the return in these portfolios. You'll see actually the less weighting to international equities in these portfolios, the lower the return has been recently. And that's not big. Once again, it's not big. We're not saying we don't chop and change really between these weightings. We're not trying to pick which one's going to be the next best performer. We're having a bit of everything, and the one asset class can pick up the slack when another asset class is underperforming. And that's the whole point of this diversification, the whole point of Harry Markowitz's research.
Yeah, and there was a question there from Grant, which is quite a good question too. And he was just commenting that I thought people's super would be invested in international shares in a balanced selection. And I must admit the return's not been as great as the 20% you mentioned earlier in the presentation.
Yeah, so the 20% comes from the just the absolute pure 100% international equities portfolio. So if you do look up the InvestSMART International Equities portfolio on our website, we will put the returns up shortly.
And a link as well.
And a link. You will see that those portfolios over the last 12 months, and 12 months is a very short period of time when it comes to investing. I would prefer everyone looked at the since inception numbers. We're 9 years since these portfolios have been created. We're having our 10-year birthday this time next year in October. So look at those longer time frames to get a good indication of what to expect. But in the last 12 months, they've done 20%. Now, to Grant's comment, a balanced portfolio, a blended portfolio, you're seeing here, 11% conservative, balanced 23%. These individual super funds and individual diversified portfolios out there will have different weightings. And so that particular component, and they'll have different exposure too. They might have a team hand-picking specific stocks.
Yeah.
And when you do hand-pick specific stocks, rather than take the index, you open yourself up to outperformance. You also open yourself up to underperformance of that index. We prefer just to take the index. So that international equities component will make up a sliver of the overall performance. So they've got lots of other different things in these portfolios. So that's why, the 20%, that big headline figure, that's that pure exposure. And that is what that asset class did for that particular 12-month period. Just depends on how they're getting it and how much they've got at it, is the impact it has on the portfolio.
Yeah, and I'll take you through some of the ETFs we use inside that international equities portfolio coming up.
Great. So, we're going to take a look now at the actual specific ETFs we use. We're also going to have a look at some broad ETF categories as well. So we just wanted to show you exactly how I went about finding them. I used the InvestSMART ETF Hub. You just in the tools section on the InvestSMART website, you'll find the ETF filter tools. This is specifically what I used to grab these ETFs that we're going to walk through.
Yeah, I'll quickly just show you where that tool feature is. I'll just share my screen, and let's go. Here we go. So we'll go to the InvestSMART website. We won't register for the webinar because we're currently here. But if you go up the top here and go to tools, there's the top performing ETFs. Compare your fund here as well. So even if I clicked on the filter tools on the right, you've got all these different types. Exchange traded funds is here, and you can see this is where Mitch was talking about. So this is a free tool. Use it to your heart's content, and I guess you'll take us through some of the things now.
Yeah, if you just could jump back to the presentation there.
Yep, sure.
Fantastic. So the first lot of ETFs I've got here to take a look at, and this comes back to how we invest ourselves. These are broad diversified ETFs. These are index tracking ETFs. So I've selected a handful here. You'll see on the far right-hand side, you've got the InvestSMART star rating. So when you are using that filter tool, you can select a star rating to select from. So, for example, nothing less than a 3-star rated ETF. The star rating system is how we rank the ETFs that we choose to use. They are based on fees, the fees and the size and the tracking error of these ETFs, and basically we give them a bit of a ranking based on that. So here we've got the a list of these are broad cap ETFs. So we've got the iShares Global 100, iShares Global World ex Australia ESG Leaders, so an ethical one there. VGS is the Vanguard International Shares Index. The Beta Shares Global Sustainability Leaders, so another ESG ethical focused ETF. And then we've got Vanguard All World ex US Share Index. So these are all ETFs that are index tracking. They are passive. They are market cap weighted. So essentially, they just hold the largest companies around the world.
Yep. And they obviously, tend to charge fairly low type fees. I mean, their management expense ratio in that third column there.
Yeah. So MER, it stands for management expense ratio, and that's what it's going to cost you as an investor. This comes out of your return, essentially. This comes out of the unit price. So you're never sending these guys a check.
Yep.
And you can see the various different holdings there. So we here specifically, and probably to no surprise to people who've watched our webinars before, we use the Vanguard ETF out of this one for our diversified portfolios. You can see diversification is incredibly important to us, and so is low cost. So that's got when you're weighing up those, it's got close to 1,500 different stocks in there. And when we were talking with Nick, and he was going through the different sectors of the MSCI All World Index, this is what you're going to get when you select to use the VGS.
Yep.
And for 0.18%. So essentially, if this ETF does its job perfectly, what it should track is that MSCI All World ex Australia index minus 0.18% per annum.
Yep. So basically getting the same kind of return as the market, less any fees.
Less the MER. That's exactly right. So if we now jump across, I've just given you a selection here. And once again, you can use the ETF filter on the InvestSMART page to filter out and scan through any of these. So I've just used a selection of the market cap, but with the specific country or region focus. So we've got iShares Asia 50. That's the 50 largest companies in Asia. So think like Tencent, Baidu, Samsung is probably the most well-known one there. We've then got the iShares S&P 500 ETF. I reckon if it's not the cheapest ETF by MER on the market,
you'll eat your hat. We don't wear hats.
Well, I won't eat a hat, but it'll be damn close.
Yeah.
Then the Beta Shares NASDAQ 100 ETF, Vanguard European Shares, then Vanguard Emerging Market. These are just a smattering. You can go really country specific with this. I know iShares have got a lot of Asian country specific ones like Korea, Taiwan, etc. You can get exposure to those specifically. So, but here in our portfolio, so in our diversified ETF, there's actually diversified international equities ETF. There's a few here we use. We use the iShares Asia 50 for our Asian exposure. We use the iShares S&P 500 for our US exposure. And we use the European shares, VEQ, for our European exposure. But for those who are wanting something a bit more exotic, you can also have a look at the Vanguard Emerging Markets ETF. That takes you into places like China, Brazil, Russia, and South America, etc.
Yep. I'll jump to the next one for you. There's a question there too, which talking about the domiciling of the. Do you want to pop that one up?
Yeah, we'll answer it now that you've brought it up.
Yeah,
and Tom knows where the webinar is going, yet he's decided to bring this up now. So this is in one of our key criteria to look at specific ETFs is where they're domiciled.
Yeah.
Because where they're domiciled, the real reason, the reason why we look at that is because of the taxation issues. So historically, these days, you won't find too many ETFs that are domiciled overseas, but do look at the issuer page, do look at the ETF page, and it'll tell you. I know not too long ago, well, it's actually been probably a few years, iShares actually made a big effort to rehome or redomicile their ETFs, and they're all now Australian domiciled, but still, I was actually looking this up the other day when I was putting these slides together, and I did see a couple there that are actually US domiciled. So I think VEU from memory, actually, when I was looking it up, so that Vanguard All World ex-US index, if you go back a couple of slides, I think that was, and it came up with an actual warning.
Oh, yes. Okay.
On the page when I was on the Vanguard website. I think that is actually domiciled in the US.
Okay, so that bottom one there. So it's even got a little asterisk, maybe.
That is why I put that in there. Actually, I was putting that in there to remind myself. Great. So let's jump ahead now. So this is where we get, for lack of a better term, really fruity. Thematic and sector specific ETFs. So there is a whole swag of ETFs that can get you really, really specific exposure. Now, our great mate Phil Bish has actually written a really good article on thematic ETFs. Spoiler alert, he says, generally speaking, to avoid them.
Well, it's a QR code there too if you're watching this on the TV or something, and you can actually just get your mobile phone, take a snapshot. We all know how QR codes work.
Yeah, and that'll take you straight to Phil's article. It's a really great article where he goes into the pros and cons of thematic ETFs. We don't use them here ourselves. As you can see, those MERs tend to be quite expensive. Saying that, there is an ETF on here that we do use, but that's more of a sector-specific ETF. So I've just grabbed a few here, for example, like Beta Shares Global Agriculture ETF. Food is the stock code there. So that looks to invest in agriculture businesses and food businesses around the world. The iShares Global Healthcare. So if you think healthcare is in positive long-term thematic you want to invest in, then that's an approach you can take. We do use in our diversified portfolios the Van Eck Global Infrastructure ETF. We use this because, to my knowledge, it's one of the only passive infrastructure ETFs on the market that you can get. There are a few actively managed funds that are available as an ETF where you can get infrastructure exposure too, but we want a passive exposure to that sector, and so this is the ETF that we use. There's an interesting one, Global X FANG Plus ETF, highly concentrated ETF. You can see there only 10 holdings. And I just popped in a Van Eck MSCI International Quality ETF. So that overlays a number of filters to handpick stocks from that MSCI All World index, and it whittles it down to 300.
Yep.
So you can see here, they as I said, the management expense ratios of these are higher. They are not pure passive index tracking ETFs, the bulk of which don't have a position in our portfolio. But if you want to, if you have a very strong view on specific things, then these ETFs might scratch that itch.
And that's something you can also use, that tool that Mitch mentioned just before, that filter tool on the InvestSMART website. You can actually search via different themes or sectors as well.
So, right, Tom's now going to take us through how we actually choose our specific ETFs.
Yeah, so it's very similar, I guess, approach to even though we were talking about before with the star rating, because it works a lot of the same idea. So we look at asset class, and does this actually give us the exposure we need? So if we're looking at something like the IVV, which is the Vanguard International exposure, we're looking at, is it actually give us exposure to the S&P 500, and does it give us anything else as well? We look at the fees. We want to keep the fees down. Obviously, that's what InvestSMART's all about. We will have different MERs, management expense ratios, and obviously, you pay that regardless if you're holding it through an InvestSMART professionally managed account, or if you decide to get it yourself through a share broker like ComSec now.
Yeah, that fee is coming out of your holding, no matter where you hold it or how you hold it, and everything that comes out of your holding detracts from your return. So, of course, all the research, the historical data suggests the lower you can get that fee, the better for your performance. Size and liquidity. This is quite important because we want to know if it's easy to transact. So is it easy if we have to sell it to get out of it? Is there going to be enough buyers if we want to get out of it? And is it easy for us to actually buy it ourselves? Is it going to take a long time? Is it going to be a bit of a spread? The difference between the buy and sell price, we want that as tight as possible. Performance, how actually does it actually track the index it's meant to track or its benchmark? Does it get the same kind of return, less fees? We'll look at location. Where is the fund domiciled? And there was a question here just from Albie saying, what does domicile actually mean? So that is where the basically where the ETF is operated from and where it pays tax.
Yep. And tax, will there be any foreign tax? We look at that closely as well and try and determine, what is going to be suited. So that's the process that we go through. I know there's a lot just plug there for boot camp, which is what I run.
I wonder how that got there.
I just might have accidentally put it in. But basically what we do is we take people through the basics of investing and we talk about these kind of things, show you how to use the filter tools as well. And you can join up for $49.50.
And here is the actual exact holdings in the InvestSMART International Equities portfolio. So these are the ETFs that we've handpicked. So they meet our criteria earlier to get us that broad, diversified global exposure. So we want to, we're very passive. And someone's actually had a question before saying, does InvestSMART look at...
Is it unhedged?
No, this one. Does InvestSMART look at where we're invested on a regular basis and then suggest any change? So this portfolio, these are the ETFs that we hold. What we do as a business, our investment committee and our team sit there and they look at there's new ETFs coming onto the market quite regularly. We look at all the ETFs existing and all the ETFs coming onto the market, existing ones are actively lowering their fees. A lot you saw Vanguard actually lower their fees this year. So we're constantly monitoring and reviewing that. And we're monitoring and reviewing our portfolio exposure from a risk perspective. So for clients, we have a formal investment committee meeting every single quarter where we review, the investment committee reviews the asset allocation. On a daily basis, we're monitoring account by account. By that, I mean if you've received any dividends, if you've added any cash, if you've withdrawn any cash from your account. We're monitoring everyone's accounts on a day-by-day basis to see if they need rebalancing to bring them back into line with this model. And this model then formally gets reviewed once a quarter and any adjustments are made. So it's very hands-off from the client perspective. They don't need to be making adjustments themselves. This portfolio will adjust as and when the investment committee see fit. They're a very experienced investment committee. That's Paul Clitheroe, Alan Kohler, our CEO, our head of funds management, Effie Zahos. So they're the ones that are overseeing these portfolio changes.
Yeah, and I guess this point here, and there's another QR code, a different one. If you actually want to see the portfolio product page, scan that. It'll take you straight to that page, complete with the product disclosure statement, which you should always read for any investment financial product. But this is literally showing you what we put into the international equities portfolio. So we're very transparent about that. I know that our CEO, Ron Hodge, he'll often say things like, if you can do this yourself, fantastic. And I know you'll cover off what Investment actually does offer in a couple of slides coming up. But essentially what we do is we're making sure that these all stay, the right balance for you. If we need rebalancing, we do that. We keep an eye out for, as you mentioned, ETFs that might be better suited or might slot in, might offer a better exposure or cheaper. When you set up automatic contributions, we do things like automatically allocate it to different areas, provide tax statements as well. Which
I just see as well, a question is on the screen, and we won't spend too much time on this. Someone asked if we were going to look at hedged versus unhedged. We did cover off currency and currency risk at the start of the webinar, so maybe do go back to that section when we had Nick on there. So, but one thing we can use hedged ETFs. We choose not to, as Nick mentioned right at the start. Generally speaking, over the long run, and these portfolios are long-term focused. That hedging, currency plays relatively little impact over the long term. So we do not use any hedged ETFs. At the absolute extreme ends, we could bring in a hedged ETF, but they are more expensive because of the cost of that hedging. So we don't specifically use them. We can, but we are long-term investors, so we much prefer to focus on that cost.
Yep, excellent. And remember, there's going to be the opportunity for you to watch this webinar directly on the same place you're watching it straight after the webinar, and we'll also upload the presentation slides for you on that page.
So we just jump to we'll keep going on here, Tom.
John Bogle's,
our mate John Bogle here. So we had Harry Markowitz before, who forms one of the foundations of what we do here at InvestSMART when it comes to diversification. John Bogle is the inventor of the ETF, founder of Vanguard. And a real focus of his was on costs, and that's a real focus of ours, as you've probably learned throughout this webinar. The reason I've got this chart quote up is for the next chart. So this is the performance of the InvestSMART International Equities portfolio, where the orangey color. Now the peer group, and you'll often see InvestSMART talk about our peer groups, because we don't just benchmark ourselves against an index or a specific benchmark, because you can't go out there and you yourselves can't go and actually get that benchmark. You can't, because you have to invest in a product that tracks it, and that product has tracking error, it's got costs associated with it, etc. So you can't get the pure benchmark return. So we track ourselves against the average of our peers. So that means the people that you can go out and invest in. So the other funds out there that you can go and buy, and you can actually go and allocate your capital to. So we compare ourselves to those. And what this chart is showing, and this is why it dates back to what Mr. Bogle was saying, is InvestSMART is our mantra is low cost. And so when we're more than half the cost of our peer group, so the average of our peer group is 1.22% per annum in fees. Our fee is 0.55% per annum, capped at $550 per annum. So you won't actually ever pay any more in management fees to InvestSMART than $550 per annum in a PMA. Now, at the start, you can see this does not actually make that big a difference. 1 year, it's not going to make a huge difference. The difference is, and this is where that gap forms, is that fee differential compounding year after year after year. When you've got almost a % difference in that fee, and you're getting the same returns as everyone else, essentially that fee is what's going to make the difference, and it's going to compound and make quite a significant difference. And that's what we're all about. That's what our John Bogle at Vanguard was all about, is that keeping those costs low and letting the asset class do the work for you.
There's a question here I might sort of just touch base on quickly. I might even put it on the next screen as well. So I know we'll have a look at this, but Tony's just saying, I read somewhere on your website that you don't reinvest the profits per annum. It's somewhat set aside in a sub account. Is this right? And is there a reason for this? I'm not too sure what that's referring to, because the InvestSMART professionally managed accounts that let you choose these passive investments, these portfolios. The default setting is reinvestment of income, which is dividends, interest payments, which then get reallocated to your portfolios. You can turn that off, and that's something you have to do, and you can get the income paid out.
Yeah, so I think what Tony might be referring to here is in our portfolios, we don't use the individual ETF DRP, dividend reinvestment plan.
Sure.
We take the cash, and that comes into the cash component of your portfolio. That then increases the weighting of your cash compared to the model, and that forces us then to redistribute that across the various ETFs to maintain the balance of your portfolio, and that's how we reinvest. So really quickly here, just going to go through, and we've talked about all the fundamental principles that our portfolios and our service as a whole. So we've built our professionally managed account service on these investment fundamentals that we've been talking about today. It's keeping the costs low, using passive investments. We know investing is really, really hard. When you go out there and choose individual companies, no matter if it's in Australia or globally, you're taking on a lot of different risks. So we choose, and there's investment professionals out there that spend their entire life investing, and most of them underperform the market. I think it's about 80% of fund managers underperform the market. These are people who spend their every single day, every single week, learning about stocks and trying to buy the best stocks out there. They underperform. So we aren't going to kid ourselves. We're not geniuses. There's only one Warren Buffett. And so what we're going to do is we're going to get these passive ETFs. We're going to track the index. We're going to get a good diversified spread across different asset classes and within those asset classes. And we're going to get that return. And then we're going to be super low on costs. We're then going to make it easy for you guys to add to your portfolios with automated contributions. Or if you're in retirement mode, you can do automated withdrawals from your portfolio as well. So every single month have $2,000, $3,000 coming out of your account, and rebalance that account for you automatically, and to avoid market timing, because that's something that we are really against. We are very much of the thought process that it's time in the market, not timing the market. It's actually, I was doing some research the other day and looking at along that very point, and I will be wrong on these numbers, but it's approximately, if you're looking at a diversified portfolio, be it balanced growth, high growth, etc., over a 1 year period, you've got about a 65 to 70% chance of having a profitable year. Over the last 20 years, if you were just invested for 1 year. If you invested for 3 years, that jumps up to about 80%. If you invest for 5 years, that's 90% chance of having a positive investment return over that time frame. So We're not here to try and time the market and jump in and out. We're just going to buy, we're going to hold, we're going to get that market return using the best ETFs that we can.
Absolutely. So I guess our argument is that, time's the great equalizer. There's a really good question here too. I was just trying to find it. And it was from Shafiqul, just asking, how safe is it investing with InvestSMART? And that's a very good question. That's something that should be a part of your investing decision. In terms of InvestSMART, obviously we're an Australian listed company, so we're listed on the ASX ourselves. Got chair people like Paul Clitheroe, one chairman, and we've got other people on the board. But the other thing is too, we'll go back to those individual holdings, those ETFs that we went through to show you. We actually set up a share brokerage account in your name, has its own holder identification number. And that just means if something was to happen to InvestSMART, it's basically safe. Your investments stay in that and you can transfer out if you needed.
Yeah, so your super fund, your family trust, your joint investments, however you choose to invest with InvestSMART, they are held on a HIN in that name. It's InvestSMART's name is not on that paperwork. You are the full legal owner. So if anything does happen to InvestSMART as a business, you'll be able to transfer out those assets and continue on elsewhere. So Tom's just putting up here our diversified portfolio returns. You can see there that the higher we go down from conservative to high growth, the higher the return becomes. But of course, the higher the risk. We say do not focus on returns when you're selecting these portfolios. Focus on that time frame. That's the best way to if you're going to focus on one thing when selecting an investment with us, the time frame is the most important. And some of you just click over the next slide, and this is our last one. That's our single asset class portfolios. You can see up the top there, the international equities. What a year it did have last year. That number is that. Do not invest in it expecting to get that return by any means. The since inception figures are a much better indicator, but of course, past performance is no indicator of future performance. We don't know what's around the corner tomorrow. If you do invest tomorrow and the market goes down and whatnot, as we said, the absolute best thing you can do is hold, or have a dollar cost averaging approach where you deploy capital month after month after month into the market, and that way you can get a nice average entry point. Tom, I think we have gone through a whole stack of questions.
Yeah, I can't see any more that have popped up that we'll cover off at the moment. But if you are interested about learning more about the products that we've spoken about today, if you think that they suit your personal situation, they might suit your goal, your time frame, your risk tolerance, or you want to actually find out more about the product itself, how it works, there's a QR code there, so you can actually scan that and choose a time where we can call you and have a chat about anything you like.
Yeah, please do. This comes through to my personal calendar and another team member also with the name Mitch. If you use this and book a call, Mitchell will give you a call.
That's a guarantee.
That's
the only guarantee.
That's a guarantee. Can't guarantee returns. Can guarantee that. And so have a chat directly with us. We are able to talk to you about the InvestSMART International Equities portfolio, our diversified portfolios, and any of the intelligent investor portfolios as well, if you were taken by what Nick had to say. But thank you, Tom.
Yep, thanks so much, Mitch. And we will catch you next time. We're trying to do more of these as they come up, but until then, if you have any questions, there's also the email address there as well, invest@investmart.com.au, but you can book a phone call, and you can also hop on the website. There's the intercom chat, staffed by real people.
Staffed by us,
By us. So thanks so much, and have a great rest of your day.